All right, welcome back to Using LLCs in Estate Planning for Professionals. My name is Barry Haimo and I am your host. Today we're talking about estate tax planning. We're going to get into how LLCs are relevant to estate tax planning. So, to begin, tax strategies, some existing ideas that we've already talked about in the prior video were using IDGITs to purchase LLC interests. If you recall, that was when you create and fund an irrevocable defective grantor trust. You fund it with a gift. That trust then uses the cash plus possibly leverage to acquire the LLC interest from your estate, freezing it in the way of a note that gets reduced in value every payment. The appreciation is shifted out of the estate for estate tax purposes while you retain income tax obligations on it, which is better taxation than an irrevocable trust. Another was a grantor retained annuity trust, where there's an annuity that goes out and whatever's left at the end of the term is gifted estate tax free. Last was a SLAT, spousal lifetime access trust, where you gift reciprocally, but not actually the same trust, with very material differences from one spouse to another. Gifts of maybe an LLC interest that can shift that appreciation outside of the estates for estate tax purposes. New ideas. Basis adjustment, 754 elections, and discounting. Let's get into it. So, basis adjustment. I have a video on basis in our YouTube series called Bite-Sized Bits of Knowledge on estate planning. It's a really helpful video, so I will assume that you understand what basis is at this time. For a 30-second overview of basis, it's what you pay for it plus all your improvements. It's a moving target, it's a variable. Your basis is one thing, your adjusted basis is another. The difference between the purchase price and your adjusted basis is how you compute your tax, gain or loss. There's something called a step up in basis versus a carryover basis. And this is a very important distinction, and it's an income tax relevant, not so much estate tax relevant. So the step up in basis is when you pass away, your basis goes up to the value at the time of death. So if you bought something 100 years ago for $10 and it's worth $10 million, your basis goes from $10 to $10 million upon death. If your beneficiaries sell that property upon death for $10 million, then their difference between $10 million and $10 million is zero, which means that there's little to no estate tax on that sale. It's a very big deal because it's quite a difference if they sold it during life or they gifted it to you during life and then you sold it later. You would get with that tax of 10 million minus 10. It's a big difference. People make mistakes about this all the time. Carryover basis is when you gift it to someone, they inherit your basis, which of course maintains that margin of tax. So step up basis is really important. Gifting on death, in one way or another, there's many ways that can happen, is important. In a business setting, in an LLC, there's two kinds of bases though. There's the basis that's the outside basis, and there's the basis that's the inside basis. The outside basis is your interest in the company. Your inside basis is your company's interest in the property itself. So to reconcile that distinction between those two bases, you can do an IRC section 754 election, which unifies those two things. What happens is that outside basis steps up, but not inside basis without it, so you can do this election to reconcile what would be two very divergent numbers. It saves tax, increases depreciation, it defers capital gains, and minimizes tax with trusts, particularly trusts, as owner. But it's irrevocable. It's difficult to revoke. So you got to be careful with your 754 election. All right, new investment opportunities. When it comes to estate tax planning, new investment opportunities, you can create and fund or seed fund a new LLC to own those investment opportunities. If you have other family members own it, maybe you can lend to it. So if you lend to it, you can lend to it at what's called the applicable federal rate, AFR, applicable federal rate, which is the lowest rate the IRS will accept or honor between related parties. So you're allowed to do business with related parties and give a better deal, but you have to at least give the right amount of interest. So if you have a new opportunity that you think is worth $100 million and you want to not have that $100 million in your estate, you can shift it out of your estate by funding with a loan a new company and having that company be owned by your family or a trust, and then that company borrows from you, invests in the property, the $100 million goes there, and you're just left with this loan. So it's a really, really smart way to shift that value anywhere you want, but not you. Discounting. What is discounting? So let me ask you a question. Two questions, really. Would you pay fair market value for a minority stake in a company? Would you pay your pro rata share of the fair market value of a minority interest? That means a non-controlling 49% or less. Obviously, you can have, at this point in the flexibility discussion of why I love LLCs, you can have a company where you own a majority interest but you don't have control. But for purposes of my question, would you buy a minority interest for fair market value? The answer is no. Do you know why? The answer is no. The reason is because you're not in control of the company. You have no idea. You have no ability to control vision, distributions, hiring, firing. You're just along for the ride. So you're not going to pay for that risk of being along for the ride. You can't control it. Let me ask you another question. Would you pay the fair market value for a pro rata share of a company that is unmarketable, meaning it cannot be sold? Nobody will buy it. No, either nobody can buy it or nobody will buy it or wants to buy it. Would you pay fair market value for that? Would you pay for that share? The answer is no. Why would you pay for something, the fair market value of it, if you can't sell it? What you're probably thinking about is, well, then why is the fair market value the fair market value? If the answer is no, the fair market value should be lower. And that's kind of precisely the thinking here. There is a discount that is permissible by the Internal Revenue Code that says that you can get a meaningful discount on the value of a business that is subject to either one or both of those things. Between a 0 and 33% is a reasonable range of discount. So if you have a $100 million business and you make it go down to 75 million, but the business hasn't changed fundamentally, you've shifted theoretically 25 million in value by taking advantage of some strategies and what's called discounting. Now, there's a lot of rules on how to do this the right way, and there's a lot of risk to do it the right way, but it can be a really effective tool. There are cases the IRS is kind of revealing its analysis. The IRS, obviously people played games with this, and then the IRS gets involved, they litigate it, and there's new cases that give precedent on how what is susceptible to risk of getting this overturned. So you got to be careful. You really got to know what you're doing here. But discounting and in the context of estate tax planning is a really good tool. Those cases that I mentioned are Strangey, Powell, and Bongard, all versus the commissioner. There's 3 separate cases, each versus the commissioner. I would say the issues you got to be mindful of are legitimate and substantial non-tax purposes. Mindful of running afoul of controlling the beneficial enjoyment under 2036, which they now view very broadly and aggressively. Lastly, substantial economic effect. It's something I've referenced multiple times in our videos. It's a common theme. The economics in the agreement must match the reality. That is something that I think I'm beating a dead horse at this point. So estate tax planning with LLCs is a really cool concept. There's a lot more to it. For today, we're covering a bunch of trusts. I think we covered three to five things of that you can do. I hope that you find it valuable for your practice to add value to your clients. In the next video, we're going to talk about income tax issues with trusts and LLCs, and we're going to wrap it up with this particular video series. Again, Barry Haimo, thank you for stopping by, and stay tuned for more.